Okay, Tyler, two companies that regularly show up on value investors' screens that look cheap, that look attractive, are Verizon and AT&T.
Yeah, you can definitely build the case in terms of an economic moat or that kind of competitive advantage that companies like this have. But when it comes to translating to shareholder value, that last part of your sentence, that hasn't necessarily been the case.
Yeah, that's exactly right. We're going to take a closer look at Verizon and AT&T, break their businesses down a little bit, talk about some of those moats, and then talk about that one metric that demonstrates how the moats that these businesses haven't paid off for shareholders, and it's not clear that they will. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, I want you to go check out our special link. Go to fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. So we're going to break down two stocks here. You can go to that link. You can get access to another 10 great ideas, really supercharge your own investing. Okay, Tyler, let's start with Verizon and AT&T. We don't need to do a deep dive on their business, but I think we can talk a little bit about some of the things they have that are certainly proven business advantages. You think about these as two of the largest wireless providers in the US. They also have other large data networks as well, other things that they do. Their broadband businesses are pretty large. Let's talk about how they stack up there.
Yeah, I mean, you could argue to use an overly simplistic term, but you could call them the toll keepers of modern internet use for a lot of homes in the United States. We can talk about it either from the wired side of the business, but at the same time, you also have, for example, on the wireless side, everybody's wireless bills, kind of more or less breaks down to 3 or 4 competitors, where it's either Verizon, AT&T, and T-Mobile. So you have this like gate. Basically, if anybody wants to use the internet, they got to use one of these 4 companies. And so there's this idea of anybody who would want to try to replicate this business starting from scratch, building out a telecommunications network, either on the wired side or on the wireless side, would take billions upon billions of dollars that most companies just don't have the ability to do. And that right there is the case for its moat, where the ability for a new entrant to come in and provide a service comparable to a Verizon or an AT&T or anything like that is so hard to do that they should have pricing power. And so you can make that case. And if you wanted to make the case for the company now, you could say, oh, well, it's so cheap. The dividend yield is so high. You've got 5G coming in. There's a lot of ways where you could justify saying why this company could be a good stock to buy. But I think what one thing that you and I have talked about, and what we keyed in on the intro here, is that defensible moats don't always 100% translate into what we can consider shareholder friendly returns. And that's where I think this concept of the economic moat that these companies have does starts to break down a little bit, from at least from an investor perspective.
Yeah, I just brought it up on the screen, but just to hit the numbers again, trading for AT&T 11.8 times and then 15.5 times earnings for Verizon, and both have dividend yields above 5%. So Verizon's is actually over 6% now. So definitely you look at them and there's the case that these are bargain stocks. And I think that's one of the things that leads people down the path of saying, wow, this is cheap. Wow, you get a great dividend yield. And then you can start justifying, like you said, a lot of the things about their moats. A couple things about the moats I want to talk about. The first is the wireless business. There certainly is some competitive advantage that they have, that they've been able to scale up these networks over time and grow them. And there's some network effects benefit as well, because the more subscribers they have, the more cash flows they have, the stronger their network should be as a result. They should build it out to be better, right? So every new subscriber that comes on makes it better for everybody else, theoretically. And I think there's some argument that has proved to be true. Yeah, I don't know that we've necessarily seen on the wireless side the high barriers to entry necessarily. As a matter of fact, I think one of the interesting things about it is that both AT&T to some extent and Verizon maybe to more extent, they actually support competition in a weird way, because they sell excess capacity to a lot of the discount wireless providers. You know, you go into a Walmart and you get their prepaid wireless and some of the other that guess what? You're piggybacking on top of Verizon most of the time, and AT&T as well. So that's a way that their networks have been strong. And then you think about the copper and the fiber, right? Those buried lines. And yeah, the competitive barriers are certainly higher. And I think it's one of the reasons we just saw Verizon agree to buy Frontier, looking to expand that broadband business as well. And that could prove to be a good move. But the key, we've seen both of these be serial acquirers over the year and not create value for shareholders. Let's talk about the metric here. There's one metric that really plays out how these stocks have not created value for their investors over the long term. And this is a metric that if you apply to great businesses over the long term, the ones that do create value for their investors have a track record of growing this one metric. And Tyler, what is that one metric?
It's free cash flow per share. There's a lot of ways that we can all talk about how businesses can create value for shareholders, but especially for businesses that are such heavy spending, infrastructure spending, kind of pay high dividends, free cash flow per share is going to be a large metric in determining the success of this company over the long term. And to be honest, neither of these companies have delivered particularly well on a free cash flow per share basis. Like you said, there's been some acquisitions over times that have been probably questionable. Both companies have, tried to get into media in varying degrees. There's been some other acquisitions, probably some weird incentives that they've tried to build into their signing people up for their networks that aren't exactly the most profitable thing. But free cash flow per share is kind of like a metric of management's ability to deploy its cash
Yeah.
and allocate its capital.
To quickly define free cash flow, this is the cash that's left over from your operations after you've serviced debt, after you've spent capital, whether it's improvements, acquisitions, expansion. This is what's left over. This is free cash that you can do with as you choose. So what I've got on the screen here, this goes back to the beginning of 2014. So this is more than a decade. You see AT&T's free cash flow has grown 51%. Verizon's free cash flow has fallen 35.6%. Here's the key. This is not per share. A company can double its cash flow, but if they double the share count, the cash flow per share, your portion as a shareholder doesn't change, right? It didn't change. So that's why that number, that per share that Tyler mentioned, is super important. So we lay that on and you see on a per share basis, Verizon's free cash flow per share has fallen by more than half. AT&T's is up about 13.5% over almost 11 years. Tyler, when I read this chart, the takeaway is despite the moats that these companies have, we have not seen any tangible evidence of either the business, certainly management's ability to take those assets and leverage them to generate free cash flow for investors. That's really important for these because dividends are a big part of their return profile. They should be. Of course, AT&T slashed its dividend sometime over that 10-year period in the past few years, part of spinning off some of those bad acquisitions that were not value accretive for investors. So if you can't grow free cash flow per share, you're going to struggle to be able to continue to grow your dividend over the long term. And even for Verizon, what's been able to grow the dividend, its growth rate for the dividend is exceedingly low, like lower than inflation dividend growth. So in terms of real value, the dividend has actually weakened, right, over the long term in terms of the spending power of the dividend that they've created.
Yeah, and when it comes to dividend stocks, it's an underappreciated aspect of dividend investing is when you're buying individual dividend stocks, it's for growth too. You can't just if you're buying for a flat dividend, you might as well be in bonds, right? You're go to a safer asset if you're looking for that steady income stream. And so for somebody to really justify going into a single stock for a dividend, it's really hard to look at Verizon and AT&T and T and their 10-year track record and say, yeah, this is the kind of dividend stock that you want to own today. Could the situation change? Yes, of course. I mean, any business can change. We could bring in new management and things could turn around. But as things have been on the current trajectory, it's really hard to see how that's the case.